Hi, I'm Matt McAleer, President and Director of Private Wealth, joined by the Moose, John Mousseau, CEO and Director of Fixed Income at Cumberland Advisors in Sarasota, Florida. Today we will be discussing our thoughts on the final quarter of 2023 and how action in both the equity and fixed income markets affected the Cumberland strategies over this period.
Yep.
Moose, biggest thing we saw for Q4 was rates coming down, dollar weakening, allowing both fixed income and equities to get their feet under them.
Matt, it was a November and December to remember. And, a remarkable decline in rates. You saw the 10-year bond, which, we saw a climb in October from a 4.60 to above 5%.
Yeah.
Go all the way down to a 3.88 to close the year, which is, by the way, where it opened the year. So, if you think about a year with a roller coaster, this was it. You ended up in the same place you started with some real highs and real lows along the way.
Investors, traders, viewers of this video may say to themselves, well, 388 to 5 and back. It doesn't sound as dramatic as that is in percentage terms.
Sure, you're talking about large price movements.
Large price movements that we haven't seen in fixed income in 15 years, 20 years.
Right. You saw the back off in the year before, which was really one-way directional movement because of the Fed raising rates. This year was this drop in rates that we saw earlier in the year because of the banking crisis, and then the pickup with fear of the Fed later in the year, and then the drop in rates as the year ended. So remarkable.
Okay, we will take a listen to how that affected our fixed income strategies. Let's cover our broad equity strategies first. U.S. Core. The U.S. Core strategy is a diversified strategy, and it is invested among different sizes of indices and ETFs and different styles, value, growth. So diversification, sometimes it helps, sometimes it hurts. 2022, big help. The U.S. core portfolio with some value and some diversification away from the NASDAQ outperformed the benchmark by almost 800 basis points.
Sure.
2023, opposite. Diversification hurt. Any capital that wasn't locked into the Qs or the S&P, really trailed.
Right.
That started to solve itself in Q4. We saw a very nice performance out of small caps, mid caps, and value. The back 6 weeks of the market actually outperformed growth.
Right.
So U.S. core got its feet under it nicely. International, very solid year, quietly in international. U.S. equity got an awful lot of attention in the media and so forth. International was solid all year. Really the only country that struggled was China. We had a small underweight in there that we did sell in Q4. Our strongest areas, Latin America and Europe, very strong. So nice, solid year in our international strategy. Then finally, in our broad strategies, our active passive strategy. Just to quickly review, we think of that as our foundation strategy. It's a 60-40 strategy. Right. The equity side is invested in the S&P 500 and the mid-cap 400. And we'll reweight those different equities depending on action in the markets and in fixed income. So the old 60-40, which occasionally gets bashed, had a very solid year. So in terms of going into 24, because of the strength in fixed income, we didn't have to do any rebalancing. That helps from a tax standpoint.
Right.
No forced selling to rebalance. So overall, broad strategies worked well this year.
Yeah. On the bond side, when you looked, particularly as we got into the second half of the year, what did we do? As interest rates went up, we expanded durations, bought some longer maturity bonds. On the taxable side, that meant buying some longer corporate bonds, which had widened out. In other words, their yields had become wider over treasuries, some longer taxable municipal bonds. And really, the idea was as rates moved higher, particularly longer term rates, we saw that even though we saw softening signs in the economy. This was the market fearing the Fed. Right. And what changed it around in the fourth quarter was as much the language of the Fed than anything. The Fed went from saying we're going to keep short rates high for longer and ended the year with we're all done raising short-term rates. Right. And in between, they talked about some moderation in the economy. All of that started to tell people, look up, look, rates are a lot higher than they were, and the bond market went on this great rally. On the tax-free side, we saw a tremendous sell-off in September and October. Why? Not so much bond fund selling like we saw last year. This was a very heavy calendar coming at the worst possible time and seeing underwriters just basically give paper away. Well, we were in there buying it. And you were able to buy suddenly 4.5%, then eventually 5% plus yields in munis, which is like either 8 or almost 9% taxable equivalent, what state you're in. So we tried to glom onto that as best we could. All of that helped a lot in November and December as rates came down. And I'm telling you, it felt like a grab-a-thon the last couple of weeks.
That extreme pain point from an investor or trader standpoint, you have to recognize that even physically and mentally in yourself.
Absolutely.
And we were on those videos. We do a video every Friday reviewing the market action and what we did in terms of positioning.
Right.
And you were stressing, and at that 5 level, you wanted to buy all you could. Yeah. And we got some pushback there, by the way.
Yeah. By the way, we were stressing it, and we felt stressed.
Yeah, that's right. So that run down to 388 in the 10-year really boosted the pricing on some of those bonds.
Yeah. It was a good way to basically end the year. Did the market become a little overbought in bonds? Yeah, maybe, but that's really a reflection of how bloody oversold it was back in October.
Right. Great, John. Let's just cover a couple of our thematic strategies to finish up. First, U.S. equity, and that's our ETF strategy, U.S. ETF. It's an equity strategy, and it focuses much of the capital on industries and sectors. What worked, what didn't work. Strong bounce in small and mid cap, as I said, in Q4. Even micro cap, which we had a small sliver of, performed very, very well. Semiconductors, good solid trade throughout Q4. Some of the weakness throughout the year was in the alternative energy space. We saw that with our solar energy position. Still long that position, rallied in Q4, but as far as performance for the year, that was a drag or an anchor. Then finally, tactical trend. Tactical trend can be in multiple asset classes and tries and attempts to see where is relative strength and trend leading us. And we want to commit capital to 2, sometimes 3 of those asset classes. Solid year there. In terms of what performed best, this is a strategy that owns individual equities, John, unlike some of our ETF strategies. Nice year out of Microsoft. Nice year out of Adobe. Nice run out of one of our newer holdings, Vertex.
Right.
So when you complement those individual equities with some of the broader mid-cap and large-cap ETFs, solid year. The second asset class in tactical was U.S. Treasuries, and on the shorter end was very helpful for the first 9 or 10 months of the year on a run rate of 4.5, 5.
4.5 to 5. I mean, you can't beat that.
Got left
paid on cash.
Got left behind the last 45 days as bonds rallied. Keep in mind, shorter term Treasuries won't rally. You're earning coupon there. You're seeing much less price appreciation. So heading into 24, I'm very pleased where all the strategies are allocated.
Yeah.
What I'd love to see is a continuation of the breadth expansion that we saw in Q4, where mid-cap and small cap can join large cap,
right?
Where healthcare and financials can follow through, and it's not just a tech growth type of market.
Right. And on the bond side, what you see from the bond market rally is our durations actually went lower, not from anything that we did actively, but the fact that many bonds that we bought that were very cheap, 95, 94 cents on the dollar, are now trading at pretty good premiums,
Right.
yielding to a call date. So it naturally shortens the portfolio up. And that's kind of what you want. You want your portfolio to get a little more defensive as rates go lower, just to kind of give you some buffer against some choppiness.
One thing we know, Moose, markets will move up, markets will move down. It's all about how we position capital. We hope you enjoyed this video and look forward to providing you with more review content on both the markets and Cumberland Advisors investment strategies. We do this on a quarterly basis. Feel free to reach out with any questions and make sure to visit our YouTube channel where you can find other relevant content such as Week in Review or strategy profiles. Thank you.